Hey folks, welcome to another product review at Finominal. Today we're going to look at the VanEck Morningstar Wide Moat ETF, which has the ticker Moat. And unsurprisingly, the fund tries to find stocks that have a moat, which you can describe as a defensible business model. And I think primarily how they go about stock selection is looking at companies that have a higher return on capital, ROIC, than the company's cost of capital and on a sustainable basis. So let's see if that works in terms of creating a fund that generates outperformance. So first thing we're going to do is look at what the right benchmark of Moat is. And if you look at the fact sheet of Moat, you will see the S&P 500. Now, interestingly, our performance benchmarking tool shows the S&P 500 value index. And we can see actually that the R squared to the S&P 500 value index is higher than to the S&P 500. Having said that, the tracking error is also higher. So you can basically pick, if it's the S&P 500 value index or the S&P 500, we're going to stick actually to the fund manager's perspective that it is the S&P 500. Now, what's worth mentioning that since inception in 2012, Moat has outperformed both indices, i.e. the S&P 500 value index as well as the S&P 500. And that's great. So next, let's see how similar Moat is actually to its benchmark index. And for that, we're going to use the securities analyzer, and we're going to look at what the overlap is between Moat and the S&P 500, where we're going to use SPY as a proxy. Now, it is worth mentioning that Moat is very concentrated. There's only about 50 stocks in Moat, and they are almost equal weighted compared to about 500 stocks in the S&P 500. So there's a small overlap. Percentage-wise, this is much more interesting. You can see there's only 40% overlap between the S&P 500, i.e. the benchmark, and Moat itself. And that's great because effectively it means that Moat is, has a very high active share and also a higher percentage of over and underperforming. But at least it's not an index hugger. So the product has the opportunity of generating value for its investors. And before we go to measuring outperformance and the alpha, we'll actually see in terms of from a style perspective, if you can see what has been driving the risk and returns of Moat over the last few years. Now, there's broadly speaking two types of factor exposure analysis you can do. One is holdings based and one is returns based. Now, on our Know Your Factors tool, we show both. So for example, you can see the Moat characteristics versus the S&P 500. You can see that in a table format. So for example, the median price to sales multiple of the S&P 500 is 2.7 versus Morningstar has 3.5. So the average holding in Moat is slightly more expensive. We also put that together on a chart where you can see all the different metrics. And effectively, you can see that the median for the S&P 500 is kind of like 50, and effectively Moat seems to be a little bit almost unfavorable on most of those metrics. There's nothing where Moat has a higher number than the S&P 500, but that's fine. Now, the other way of looking at Moat is a returns-based factor exposure analysis, where we're going to look at the factor betas over time. And both methodologies often come to the same conclusion. For example, you can say a fund is cheap from a holdings-based factor exposure analysis, and is cheap from returns-based factor exposure analysis, but not always the case, simply because the holdings can change on a day-to-day basis, versus with a returns-based analysis, you always look back 1 year or 3 years or whatever you define time period. Anyhow, here we see the factor betas over time. And what's kind of interesting, that there was consistent positive exposure to the size factor, i.e. small caps. There was consistently negative exposure to the momentum factor, as well as kind of like value, except over the last 2 or 3 years when value has been outperforming, so that was quite nice, and kind of flat exposure to low volatility quality. Now, given that this fund selects businesses based on their defensive business models, I actually would have expected a much higher positive beta to the quality factor and even low volatility. If you think about businesses that have highly defensible characteristics, they should not be particularly volatile. But it is what it is, so kind of interesting to know. So let's see how the fund actually has done from an alpha generation perspective. And we're simply going to look at like the performance of Moat again versus its benchmark, the S&P 500 index. And what we saw earlier is this outperformance compared to its benchmark, which is great. It's become a little bit more differential the last 4 to 5 years. Before that, it was much more index hugging. But outperformance, not the same thing as alpha. Alpha is an unexplained return, which you can also equate to manager skill or luck in some cases. And we can see this down here. So these are the returns that we can explain via the exposure to the market or to factors. And what's quite nice to see is that Moat actually has pretty consistently generated positive alpha. You're never going to see a fund that always has positive alphas, but broadly speaking, this is interesting. There was a couple, like 1 year that was quite bad, but also a couple of years that were quite good. So kudos to this ETF, right, in terms of generating alpha, which I think on an annualized basis has been around 1%. Now, in case you like the ETF, but are wondering, are there cheaper alternatives? We can look at the fee reducer. Now, let's see what we see here. So effectively trying to see, are there any mutual funds or ETFs that have similar fact exposures but are at low cost? And we're showing you something. So Moat charges 46 basis points versus this other ETF, which is DIA, Kraft Social Security Choice Equity Fund, and charges 17 basis points. But it's not as good. And of course, it is worth paying for performance. Now, there's a bunch of other, by the way, ETFs, mutual funds you could look from a comparison perspective. But when you think about Moat for stock selection, there's of course one name that comes to almost everyone's mind is Warren Buffett. So what we can do is we can try to see, just out of interest, how Moat performed versus Berkshire Hathaway. And this Berkshire Hathaway, which is Warren Buffett's vehicle, of course also selects companies that are defensible. And what we can see here is effectively that since 2012, effectively both have almost achieved the same performance, but you can also see that the trends in performance were quite different, which indicates different styles. And we could look at this from a factor exposure perspective. So you could see the blue columns. This is for Berkshire Hathaway exposure to value and to low volatility. So there are differences. So that's not a true alternative. It's just something to think about. That kind of wraps it up. So Moat in terms of ETF, in terms of thinking what we learned so far, it has beaten its benchmark, which is great. Alpha generation was consistent and more or less and positive. So kind of interesting vehicle in terms of from an equity allocation perspective. Concentrated, high active share, low overlap. We kind of like that. So that's it in a wrap. Hope you enjoyed this. Have a nice day.